Welcome to Capital Allocation Lab. We're here today for, well, clear lessons in long-term investing. We ground these in classic texts, but, update them for today. This deep dive, it's all about Graham's enterprising playbook.
That's right. Specifically, Chapter 15 of The Intelligent Investor. This is where Graham really lays out the blueprint for hunting down those hidden bargains.
And it's definitely a chapter that separates the serious student from the casual reader, wouldn't you say?
Oh, absolutely. It demands real effort, real rigor. It's about building a repeatable process, finding value where, frankly, most people just aren't looking.
Our mission today is simple. Improve your judgment about businesses, about portfolio decisions, one idea at a time.
And the core goal here is translating Graham's methods into something actionable, something like a modern checklist.
Right. We need to be quite surgical, I think. Figure out where the original mechanics still work, discuss where the math maybe needs adapting for today's market, with all the intangibles.
And how to apply it responsibly. That's key.
Absolutely. And just a standard reminder, this is purely educational. We're focused on teaching how to think about capital, about risk, not telling you what specific stocks to buy. If you find value in these lessons, subscribe and like to support more educational episodes.
Okay, let's dive in. Let's unpack this crucial playbook. So Graham kicks off Chapter 15. Well, not with a big promise of easy riches. Quite the opposite, actually.
He starts with humility.
Exactly. A necessary dose of it. It's essential for any strategy that requires, extra effort like this one does. He gives every ambitious investor a pretty profound reality check.
Which is
the idea that just a little bit of extra research effort will easily beat the market. History fundamentally contradicts that.
Yeah, and we see that play out all the time, don't we? We've got more data, faster news than ever.
Right.
Yet even professional funds, the ones with huge teams, massive resources, they often fail to beat a simple index fund after you factor in their fees and trading costs.
That fact alone tells you something important. Stock selection isn't just challenging, it's structurally difficult.
Yeah. Okay, so why? Graham points to two main reasons, right?
He does, and they're still completely relevant today. First, the market is just incredibly efficient. It sucks up the best available public information so fast.
Meaning,
by the time you read about some amazing new prospect in the news, today's stock price, it probably already reflects that collective knowledge. The price is usually a pretty decent summary of what's publicly known. The obvious easy money is gone.
Makes sense. And the second reason?
It's more psychological. It's convergence.
Yeah.
So many analysts, so many investors, they're running similar screens, using similar models.
Chasing the same stories.
Exactly. Chasing the attractive growth narratives. And crucially, they all end up paying up for it, sometimes dramatically paying up for that feeling of certainty or, glamour.
So everyone's crowding into the same obvious plays. The real bargains aren't there.
They're not. They hide. They hide in complexity and neglect, or maybe in temporary solvable trouble that requires actually digging through the footnotes.
Okay, so this is the foundation then, the enterprising approach. Your process has to be different.
Deliberately different. Structurally different. And I stress deliberately because just being contrarian for the sake of it, that's usually a quick way to lose money.
Right. It's not about being opposite. It's about exploiting specific inefficiencies.
Precisely. The real edge comes because the market consensus, it systematically overpays for the comfort of certainty. And it underpays for things like inconvenience, complexity, temporary trouble, things that just require more work.
That temporary trouble. That's where the margin of safety often lies. But you mentioned humility being central. Why is that so critical as a process control?
Because you just cannot control the future. Simple as that. You can build the most amazing spreadsheet, but the economy, politics, competition, they always throw curveballs you can't predict.
So humility keeps you grounded.
It acts like a governor on the process. It reminds you, okay, since I can't control the future, I must keep the mathematical odds on my side today.
And how do you do that?
Not with bravado, not with aggressive predictions. You do it by sticking to 3 non-negotiables. Buying at an excellent price, demanding a certain level of quality, and maintaining robust diversification. Your success comes from that disciplined process, not from trying to be a fortune teller.
Okay, so to really get Chapter 15, it helps look at where it came from, right? Graham's own firm, Graham Newman.
Absolutely. That's the origin story. They weren't like a typical fund manager today relying on market calls. Think of them more like a research lab dedicated to repeatable value capture.
So avoiding hunches about the economy or where the market's going.
Exactly. Instead, they pursued defined, repeatable categories of opportunity. specific types of situations.
And these categories were key because they didn't need macro forecasts.
Right. They relied on structural inefficiencies in the market or, impending corporate events. The buckets were really specific. Things like defined outcome situations, liquidations, maybe corporate arbitrages where the payout was kind of known, just the timing was uncertain.
Okay, what else?
They also successfully used what they called related hedges, often involving convertible securities.
Related hedges. What does that mean exactly?
Well, a related hedge is where the safety mechanism, the protection, is structurally tied to the underlying asset you own. So think about buying a convertible bond.
Okay.
You get the promise of debt repayment, that's your protection, but you also get the option to convert it into equity if the stock goes up. That's your upside. The relationship is defined, it's structural.
Got it. And then, of course, the famous one, the net current asset bargains.
Yeah.
The net nets.
The legendary net nets, yes. We'll definitely dig into those more later. But what's just as interesting, I think, is how rigorously they analyzed what didn't work well enough.
Right. They tracked failures, too, what didn't meet their standards for, say, capital allocation efficiency.
Exactly. They were meticulous. They eventually dialed back or even abandoned two specific methods that just weren't consistent enough. First was buying stocks based purely on attractive narratives or perceived growth if the price was above their working capital value. So paying a premium for a story.
Right. When you do that, you sacrifice that hard balance sheet margin of safety.
Okay. And the second method they backed away from?
That was the pursuit of unrelated hedges.
Okay. If a related hedge ties protection directly to the asset, what's an unrelated one? And why did that fail?
An unrelated hedge was basically just shorting some stock that looked expensive, often in a totally different industry, hoping it would fall and offset losses in your main long portfolio.
So relying on a general market view to hedge.
Pretty much. Using a general market timing call or unrelated price action to manage risk, Graham found that introduced way too much noise, too much volatility. It made the strategy inconsistent and unreliable, especially after trading costs. The lesson there seems to be your protection should be as structural as your opportunity.
That's a great way to put it. It's a powerful lesson for any investor today. Track your results by category, not just by individual stock names.
So if you have a theory, like, okay, I'm going to buy low multiple cyclicals with strong balance sheets, and that whole bucket of stocks underperforms for years, even though you gave it a fair shot.
Then you need to be ruthless. Retire it or fundamentally overhaul it. Don't let sunk costs or emotional attachment keep you tied to a failing strategy.
It reinforces that idea of viewing your investing like a small, disciplined research lab.
Exactly. You don't need an opinion on everything. You just need to find a few methods that are sound, repeatable, and honestly, often pretty boring.
And the real edge isn't the method itself necessarily, but the temperament.
The temperament to stick with it, especially when those methods are out of favor, which they inevitably will be sometimes. That's the hard part.
Okay, so Graham's real genius, maybe, was turning this philosophy into concrete, mechanical actions. He showed how to build a practical screen, right? Layering filters.
Yes, absolutely. He started with initial cheapness, demanding a low price relative to earnings, and then layered on 5 additional, quite conservative filters.
So we're going to translate that original 6-point screen, which he demonstrated using something called the S&P stock guide back then.
Right, a physical book.
To a modern checklist, specifically for operating companies like industrials.
This really is the heart of the enterprising investor's method. Let's break it down.
Filter number 1.
Reasonable financial condition, first part. A current ratio of roughly 1.5 times or better.
Why 1.5? Why not just 1?
Well, a 1-to-1 ratio, where current assets just equal current liabilities. That offers zero margin of safety. What if receivables are slow to collect? What if inventory needs a write-down? The 1.5 gives you a buffer. It basically says, even if you have to write down a third of your current assets, you can still cover all your short-term bills. It's about non-negotiable short-term strength.
Okay, and there's a debt rule tied to this, too.
Yes, a conservative one. Total debt should not be materially above net current assets. For an industrial company, think about what that means.
It means the working capital is so strong that even if you paid off all debt, short-term and long-term, right now,
there would still be meaningful liquid working capital left over. It's a huge buffer against trouble.
Wow. Okay. Filter 2.
Earnings stability. Graham insisted on seeing no net losses in the last 5 years.
This isn't about finding high-growth rockets, then?
Not at all. It's about survivability. A 5-year look back ensures the business has proven it can stay solvent, stay profitable across a typical business cycle. It needs to survive some bad weather. If it can't do that, it's just too fragile for this approach.
Makes sense. Third filter.
The dividend record. The requirement here is super simple. The company just has to pay something.
Doesn't need to be a high yield.
Nope. Even a modest recurring dividend is a powerful signal. It shows board discipline. It confirms the business is actually generating real cash flow, not just accounting profits. And it forces management to face financial reality every quarter instead of just, empire building or reinvesting poorly.
Okay. Fourth filter.
Earnings growth. Again, Graham wasn't demanding hyper growth here. He just demanded realism. The rule was simply that last year's earnings had to be higher than they were 5 years ago.
Just showing some directional progress.
Exactly. It ensures you're not buying something in permanent structural decline. It's setting a floor on your expectations, not aiming for the moon.
Got it. Fifth filter.
Asset backing. This is fundamental, Graham. We look for the start price to be below roughly 1.2 times net tangible assets.
Or tangible assets, so things you can touch and count, basically.
Pretty much. Property, plant, equipment, inventory, less the liabilities. This rule is specifically designed to stop you from paying a big, unverifiable premium for things like goodwill, brand names, or, vague future potential.
The 1.2x multiplier acknowledges some value beyond liquidation, but strictly limits it.
That's the idea. It keeps you focused on assets you can conservatively value. Safety first.
And the final filter, the starting gate.
Initial cheapness. Graham suggested starting the search with stocks trading at 9 times trailing earnings or less.
9 times. Why so low?
Because it forces discipline. It forces patience. Statistically, a multiple that low screens out the vast majority of companies that are currently popular, currently celebrated, or trading on really optimistic future projections. It stops you paying growth prices for what are often, statistically speaking, just average businesses.
So looking at this whole 6-point framework, the genius isn't picking the one winner.
No, not at all. The value comes from buying a diversified basket of solid businesses where the math, the odds favor you, the buyer, at today's price, regardless of what the future holds exactly.
The whole philosophy is safety first, realism about growth.
And an obsession with cash and countable assets. It's really the polar opposite of story-based investing.
Graham didn't just present theory right. He backed it up with data, with tables showing results.
Yes, and those old tables still teach incredibly valuable lessons. Takes table 15-1. It showed a sample of low multiplier industrial stocks that met his tough criteria. And the results, they were mixed.
Mixed. Some did well, some lagged.
Exactly, and that's precisely what should happen with this strategy. The mixed result is the feature, not a bug.
How so?
Because the entire basket, every stock in it, was anchored by strong asset coverage and decent earnings. So, the downside risk. It gets spread out, shared, limited across many positions. One failure doesn't sink you.
But the upside?
The upside is asymmetric. It comes from the few names in that basket that either see a strong fundamental turnaround or their valuation multiple dramatically re-rate, say, from 8 times earnings up to 15 times, or they get acquired at a fair price by a bigger company.
Okay, that makes sense for the general industrials. But table 15-2, that one often gets people's attention. It showed something pretty shocking.
It really did. That table documented periods where really well-known, respected brands, companies everyone knew, were briefly selling for less than their net working capital value.
Let's unpack that because it sounds almost unbelievable today. Net working capital value. That's current assets minus current liabilities.
Minus all liabilities, short-term and long-term. So you could theoretically buy the company's cash, its receivables, its inventory, subtract everything it owed.
And the remaining price for the actual operating business, the plants, the brand itself, was zero or even negative.
Exactly. You were effectively getting the factories, the machinery, the famous brand names, the long-term assets, the whole ongoing business for free.
How on earth does the market let that happen, even briefly?
Pure structural fear, usually panic selling during a massive recession or maybe a really deep industry-specific downturn. In those moments, investors get so fixated on the terrifying current earnings numbers or the fear of imminent bankruptcy.
They completely ignore the balance sheet reality.
They do. They treat a viable ongoing business as if it's about to be rapidly liquidated tomorrow, even if it has decades of history.
Okay, so the actionable intelligence here for listeners today. These windows are rare.
Extremely rare. And fleeting. You cannot wait until the market is in free fall to start building your screen, analyzing balance sheets, deciding how much to buy. It's too late then.
So preparation is key.
Critical. Prepared investors need a watch list, yes, but more importantly, they need a written playbook long before the storm hits.
Meaning pre-deciding exactly what qualifies a stock for purchase and how much you'll allocate. Like, say, a default 2% position.
Precisely. Pre-deciding those things prevents two fatal flaws during a panic. First is fear-driven inaction. You know you should buy, but you just freeze up. Second is greed-driven oversizing. You bet way too much on one stock just because it looks so unbelievably cheap.
Discipline has to be installed when your mind is calm and rational.
Absolutely. That's the only way it works under pressure. Graham was, as we said, rigorous. He tested everything, including simpler single-factor strategies.
Like just buying stocks with low PE ratios.
Yeah.
Or just high dividend yield.
Exactly. He wanted to know, is one simple metric enough to consistently beat the market?
And the conclusion was?
He found that, yes, any of those single factors, low PE, high dividend, maybe focusing only on large established companies, they were consistently better than doing the exact opposite, like buying high PE stocks with no dividends.
Okay, so better than the worst strategy.
Right. But, and this is crucial, they were not consistently superior to the broad market index or to his own layered multi-factor approach that we just discussed.
Okay. So that's the key takeaway. A single metric, it's a great starting filter, essential even, but it's rarely enough on its own to give you a real edge.
The power comes from the layering, demanding that a stock clears multiple hurdles simultaneously. Financial health, stability, cheapness, asset backing.
Beyond the screen itself, did Graham's analysis point to any other structural advantages? Things that consistently improved outcomes?
Yes, two really important ones came through. First, perhaps obviously, quality matters. Businesses with durable, consistent earnings histories and strong conservative balance sheets, they just weather storms better. They have more options. They have far less risk of being forced into selling shares cheap to raise cash, or worse, going bankrupt. It's basic survivability protection.
Okay, quality helps survival. What was the second advantage?
Understanding portfolio math. This is critical.
Yeah.
You have to be realistic about how you compare your results. Think about a cap-weighted index like the S&P 500.
Right, the biggest companies get the biggest weighting, Apple, Microsoft, etc.
Exactly. The index inherently leans into the stability and success of those giants. The winners get bigger and bigger in the index. Now, contrast that with what we're building here, an equal weight, deep value basket.
A collection of smaller, often unloved, maybe temporarily troubled stocks, all weighted roughly the same at the start.
Right. You have to be mentally prepared for that portfolio to behave differently. You should expect higher tracking error, meaning it won't move in lockstep with the S&P 500. You should expect more volatility and often slower recoveries after a market downturn.
So if you build this basket but expect it to bounce back just as fast as the big tech stocks after a crash,
you're setting yourself up for behavioral failure. You'll get impatient. You'll bail out at the wrong time. You must plan your position sizes and, critically, your holding period, specifically to account for the likely bumpier ride and slower recovery profile of an equal weight deep value strategy.
Okay, Graham and his partners, they were known masters of special situations, right? Particularly things like merger arbitrage.
They were. But the examples Graham includes in the book, they actually serve as really important warnings. They show that even these seemingly defined outcome plays are definitely not risk-free. There's significant event risk.
We tend to focus on the potential profit, right, that's spread between the current stock price and the expected deal payout. But what are the real risks that can blow up an arbitrage trade?
The main ones. The deal just breaks entirely. Regulators block it, or the terms change unexpectedly, making it less profitable. Or maybe the timeline just slips and slips, tying up your capital for way longer than you planned.
And when capital is tied up longer, even if the deal eventually closes, the annualized return drops significantly.
Exactly. The opportunity cost mounts. That expected return per unit of time can just collapse.
This seems like a really specialized area.
It is, and it brings us to a crucial point of self-awareness for anyone considering this enterprising approach. If you lack the specific tools, maybe the legal expertise, the time to constantly monitor regulatory filings, or if you just don't have the robust temperament needed to handle the stress of outright event risk,
Then maybe just avoid special situations altogether.
honestly, yes. For most people, it's probably best to avoid them entirely. This is often investing that requires a dedicated professional setup, not something you dabble in casually. You can absolutely succeed as an enterprising investor without ever touching merger, arb, or liquidations.
Okay, but let's say someone does have the right setup and temperament. For those who choose to dabble, what are the strict rules needed to keep the risk contained?
You need absolutely non-negotiable rules. First, keep the positions very small, tiny. Second, diversification is vital, but it has to be across uncorrelated events.
Meaning, don't own 3 different merger arbitrage deals that are all waiting for approval from the exact same regulator.
Precisely. Because if one gets blocked, they might all get blocked. They could fail together. And third, you absolutely must have an explicit, predefined rule for getting out if bad news fundamentally changes the deal's odds or economics.
So the edge has to come from process and probability, not just hoping the deal goes through.
Yes, it has to be process-driven, based on careful assessment, not fueled by adrenaline or wishful thinking.
Okay, let's pull all this together. History, philosophy, let's make it practical. A step-by-step workflow for building a modern screen that listeners could actually use with today's tools. We can break it into, say, 5 steps, A through E.
Sounds good. Step A, universe and hygiene. Where do we start? First, immediately screen out financials and utilities.
Why exclude them?
Their balance sheets are just fundamentally different. Banks have massive leverage by design. Utilities have regulated assets. The standard industrial checklist we've been discussing, it just doesn't apply safely to them. You need specialized lenses for those sectors.
Okay, financials and utilities are out. What else in step A?
Focus only on businesses with at least 5 years of operating history. This ties right back to that earnings stability rule we talked about. You want some track record.
Makes sense. Any other hygiene checks?
One more crucial one. Require positive operating cash flow in at least 4 of the last 5 years. We want to see real cash coming in the door, not just accrual earnings, which, can sometimes be managed or manipulated.
Right, cash is king. Okay, that's step A. What's step B? Price and quality gates.
For price, we can start with Graham's rule, trailing PE less than or equal to 10. But PE has its weaknesses, especially with different debt levels. So a modern, arguably better analog is critical. Enterprise value to EBIT or EVIBIT. We'd look for that to be 8 or less.
Why is EVIBIT often better?
Because enterprise value accounts for both debt and cash on the balance sheet, and EBIT earnings before interest and taxes gives you a cleaner look at operating profitability before financing decisions, and taxes muddy the water. It compares the total value of the business to its core operating profit.
Okay, PE under 10 or EV/VPIT under 8. What about the quality gates in step B, liquidity first?
Yes, reaffirming Graham's safety. Current ratio of 1.5 or greater. And maybe add the quick ratio that's current assets minus inventory divided by current liabilities, preferably above 1.0.
Wow, the quick ratio too.
It's an extra layer of safety. It ensures the company has enough liquid assets to cover short-term bills, even if its entire inventory became worthless overnight. Maximum protection.
Okay. What about the debt rules in step B?
For industrials, stick to the classic. Total debt less than or equal to net current assets. But look, that can be pretty restrictive today. So a reasonable alternative is to require that interest coverage, typically EBIT divided by interest expense, is strong, say 4 times or better. That ensures they can easily service their debt, even if earnings dip.
And the dividend rule from before?
Still applies. The dividend must be present, and critically, it must be covered by free cash flow, FCF, not just by reported net income. FCF is the cash left over after all operating expenses and capital expenditures. That's the real money available to pay dividend.
Got it. Moving on to step C, asset backing.
We stick firmly to that safety layer. Stock price must be less than or equal to 1.2 times net tangible assets. For this core enterprising basket, that's pretty much non-negotiable.
Is there any wiggle room there?
Maybe the absolute minimum, especially if you're looking at very cyclical companies, is that the price is at least below the stated tangible book value, so 1.0x. But only if you've done the work and have strong reason to believe the inventories are high quality and valued conservatively on the books. But 1.2x is the safer general rule.
Okay. Step D, stability and direction.
This reinforces the earlier rules. Reconfirm, no net losses in the last 5 fiscal years. And add a check for capital efficiency. We'd want to see the 5-year average return on invested capital, ROIC, be at least, say, mid-single digits, maybe 5-7% or higher.
Why add ROIC?
It prevents you from buying a business that's cheap simply because it's structurally awful at generating returns on the capital it employs. You don't want cheap and bad. You want cheap and fundamentally sound, even if it's currently out of favor. An improving ROIC trend is obviously a nice bonus.
Okay, steps A through D give you a quantitative list. But then comes the crucial step E, the judgment layer, human only.
Yes. This is where you filter out the quant traps, the value traps. You must actually read the financials. At minimum, the last two annual reports, the 10Ks, and the latest quarterly filing, the 10Q.
And the first test here is basic understanding.
Absolutely. If you cannot understand the business model, how it makes money, who its customers are, what the industry drivers and key risks are within, say, 20 minutes of reading the management discussion section, reject it immediately. Lack of comprehension is the ultimate unquantifiable risk.
What else are we looking for in Step E?
You're hunting for landmines. Scan aggressively for off-balance sheet liabilities, things like big pension deficits, weird leasing arrangements, potential lawsuits, and be super wary of companies that constantly report adjusted earnings with lots of recurring, non-recurring charges. That often signals chronic problems management is trying to paper over.
So Step E involves some real critical thinking.
And asking yourself a key philosophical question. If this business went private today, could it survive and thrive for the long term without relying on the public stock market for funding or liquidity? If the answer feels like no, it probably doesn't meet Graham's standard of true underlying durability.
Okay, so A through D generate the candidates. Step E weeds out the dangerous ones. What does the final portfolio look like?
The output should be a basket. Maybe 15 to 30 names. And crucially, size small enough initially, say 2% to maybe 4% allocation per name, so that if one blows up unexpectedly, it doesn't cripple your overall plan.
And we have to remember the patience requirement here.
Absolutely critical. The catalyst for these boring asset-backed businesses usually isn't some exciting news announcement. It's simply time plus survivability. Your intended holding period needs to be thought of in terms of business cycles, maybe 2 or 3 full cycles, which could easily be 5, 7, or more years, not quarters. You need to give normalization a chance to happen.
Okay, let's talk about the net nets. The company's trading below net current asset value. This seems like one of the biggest challenges in applying Graham today. And they're just so rare, right?
They really are. In most normal market environments, especially with so much liquidity sloshing around, finding true net nets is incredibly difficult. When they do pop up, they're often tiny microcaps with terrible liquidity, or they have really complex, worrying governance issues, or they're maybe based in questionable jurisdictions.
So we can't just rely on finding 1930s-style fire sale bargains anymore. How do we adapt that core principle, price offers protection first, without completely losing the margin of safety?
We have to adapt. We need faithful variations that capture the spirit of that balance sheet protection, even if the exact math is different. I think there are 3 main ways to do this.
Okay, what's the first adaptation?
Look for almost net nets. These are companies priced maybe near or just slightly above their net current asset value. Now, because you're bending the original strict rule here, you must demand extra safety factors as compensation.
Like what?
It's like extremely low leverage. Ideally, the company should have more cash than debt. And you need crystal clear evidence of insider alignment. Are the managers, the directors buying significant amounts of stock with their own money? That shows conviction. And even then, with these almost net nets, you need extra diversification and really strict position size caps. Maybe never go above 2% in one name.
Okay, almost net nets with extra safety checks. What's the second adaptation?
Look for asset-rich compounders at plain prices. These aren't distressed companies. They're stable businesses, often in boring industries like infrastructure or manufacturing. They have conservative balance sheets with meaningful, tangible assets providing a cushion, and they have the ability to reinvest their cash flow at acceptable rates of return over time.
So the key here isn't buying at a fire sale price relative to current assets.
No. The key is buying them below a sensible appraisal of their overall economic value, considering both assets and earnings power. You're buying a quality business at a fair or plain value price rather than a potentially broken business at a bargain basement price.
Got it. And the third adaptation?
This one involves timing. Target cyclical deep value with balance sheet airbags. Think about market leaders in really heavy industries. Chemicals, mining, heavy equipment, when their specific cycle hits rock bottom.
Okay, when reported earnings might be near zero, making them look expensive on a PE basis.
Exactly. But if you look at their assets, they might look incredibly cheap. The requirements here have to be super stringent, though. First, the balance sheet must be highly liquid, lots of cash, low debt, to ensure they can survive the trough of the cycle without financial distress. Second, the replacement cost of their physical assets, what it would cost to build their factories or mines from scratch today, must be far, far higher than the current enterprise value of the company.
This sounds like a strategy that requires serious patience. You might buy when things look terrible.
And they might stay looking terrible for 2 or 3 years before the cycle finally turns. You absolutely have to expect pain before gain with this one.
So you size positions accordingly, knowing they'll be volatile.
Absolutely. You size them small, knowing they'll likely underperform in the short term and require maximum patience. But what connects all three of these adaptations, the almost net nets, the asset-rich compounders, the cyclical deep value plays, is Graham's North Star.
Which is?
Price offers protection first, upside second. The absolute priority always is minimizing the risk of permanent capital loss through a strong, tangible anchor to value.
Okay, this is great theory. Let's try to make it concrete with a quick hypothetical example. Let's invent a company, Atlas Components.
Okay, Atlas Components, what's the scenario?
Atlas is, say, a mid-cap industrial company. They supply specialized parts to original equipment manufacturers, OEMs. They've had a rough couple of years. Revenues have shrunk, and the stock price is down, let's say, 55% from its peak.
Okay, and the valuation metrics?
Right now, it's trading at 9 times its depressed trough earnings, and crucially, it's trading at exactly 1.0 times its tangible book value.
Interesting. Balance sheet.
Looks solid. Current ratio is excellent, maybe 2.1x, and total debt is actually slightly below its net current assets. And despite the downturn, it's still managing to pay a modest dividend, and that dividend is covered by its cash flow.
Okay, let's run it through our checklist. Filter 1, financial condition.
Pass, right? At 2.1x current ratio, debt below net current assets.
Yeah.
Very liquid, conservatively levered.
Agreed. Pass. Filter 2, earning stability. Assume no net losses in the past 5 years despite the recent margin pressure.
Yes, let's assume it stayed profitable, even if barely, through the downturn, so pass.
Okay. Filter 3, dividend record. Small but persistent, covered by cash flow.
Pass.
Filter 4, earnings growth. This one's maybe marginal. ETS is down from the peak, but is it still higher than it was 5 years ago?
Let's say yes. Directionally, it's still above the level from 5 years back. So a marginal pass, acceptable given the balance sheet strength.
I'd say so. Pass. Filter 5, asset backing. Trading right at 1.0x tangible book. Let's assume inventories look okay upon review. And filter 6, initial cheapness. 9 times trough earnings. EV/EBIT probably around 7 given the low debt.
Definitely pass. So
Yeah.
quantitatively, Atlas Components clears the hurdles.
Okay, but now comes the crucial step E, the human judgment layer. We read the annual reports, the management discussion. What do we find?
Let's say we find management acting prudently. They've paused acquisitions, they've cut capital spending down to just essential maintenance, and importantly, they've been repurchasing stock, but only when the price dips below tangible book value.
Okay, that's a good sign. Shows internal conviction in the asset value. What about the underlying business strengths?
Maybe sticky customers, high switching costs for the specialized parts they make, and maybe no single customer is too dominant, say none or more than 15% of sales, reduces concentration risk.
Good. But step E also forces us to identify the risks. What are they for Atlas?
Let's say the primary risks are its exposure to 2 highly cyclical end markets, maybe heavy construction equipment and the automotive sector. Both are weak right now. And maybe there's a potentially tricky labor contract renewal coming up next year that could pressure margins further.
Okay, so we have the full picture. Quant screen passed, human layer reviewed, strengths and risks identified. What's the portfolio decision here?
Based on this, Atlas looks like a solid value opportunity that meets the criteria. But it's still cyclical, and it carries that specific labor contract risk.
Right, so it's not a bet the farm situation.
Definitely not. It probably earns a modest position size within our diversified value basket, maybe 2%, perhaps up to 3%, in a 25-name portfolio.
And the investment thesis, what are we banking on?
Pure Graham. Survivability first. Atlas has the balance sheet strength to easily survive this down cycle. The payoff comes later, from eventual reordering normalization in its end markets, and maybe a modest expansion of its valuation, multiple, perhaps back to 12 times more normal mid-cycle earnings over the next, say, 3 to 5 years.
And critically, we define the exit plan now before we even buy.
Absolutely. What would trigger a reevaluation or sale?
It shouldn't primarily be based on the stock price hitting some target. It should be based on the safety case breaking down. For instance, we might decide to reevaluate, trim, or potentially sell if total leverage creeps up above, say, 2.5 times EBITDA. Or if management suddenly starts reporting a string of large, one-time restructuring charges that make us question the true underlying earnings stability. That's when the thesis might be broken. So important to keep coming back to this. Graham's mechanical methods, his screens, his rules, they work largely because they're brilliantly designed behavioral guardrails.
Right. They impose discipline against our own worst psychological
Yet,
impulses.
the impulse to panic sell when things look scary, the impulse to get overexcited and bet too big on one idea, or even just the impulse to fiddle and trade too much when the plan simply requires patience.
He gives us, effectively, 3 clear behavioral guardrails to counter these impulses. What's the first one?
Pre-committed sizing. Your default position size for this strategy has to be modest, maybe around 2% of the value basket. And you should probably set a hard rule. Never allocate more than, say, 5% at cost to any single name using this specific deep value approach.
Why is that so critical?
Because the moment you start putting 10% or 15% into one stock because you feel really sure about it, you're no longer relying on the statistical advantage of the diversified basket. You're relying on your personal conviction, your ego, and that's where discipline breaks down.
Okay, small default sizes, strict maximums, guardrail number 2.
Pre-committed patience. You have to go in knowing the minimum intended holding period is long. Probably 3 to 5 years at least. Unless, of course, something fundamental breaks the balance sheet, deteriorates badly, or management loses all credibility.
So you don't sell just because the stock price hasn't done much for 6 months?
Absolutely not. If you sell a deeply undervalued asset-backed stock just because its boring earnings reports haven't excited the market yet, you're throwing away the very advantage you sought, allowing time and survivability to be the catalyst.
Makes sense. And the third behavioral guardrail?
Pre-committed selling. Just as important as buying right is knowing when to sell. You need discipline around taking profits. Trim or sell when the stock price clearly runs far ahead of a sober, conservative estimate of its intrinsic value. Don't get greedy.
And sell immediately if the safety thesis breaks.
Yes. If leverage balloons or share dilution gets out of control, violating your original safety criteria, you sell. And this is key when you do sell, either for valuation or safety reasons, that capital needs to be immediately recycled back into new opportunities that still meet the demanding checklist standards. Keep the process going.
You mentioned journaling earlier. How does that fit in as a behavioral tool?
I think journaling is almost a superpower for disciplined investing. When you buy a stock using this method, write down why. What specific checklist criteria did it meet? What were your assumptions about its cash flow, its assets, its durability, and what were your specific exit triggers?
And then you review that entry later.
Yes. Reread it 6 months later. A year later. You will inevitably see things differently. You'll catch your own blind spots, maybe flawed assumptions you made, or moments where you perhaps compromise slightly on the screening rules. That self-reflection, that learning loop, is the entire point of treating your investing like a personal research lab. It forces self-correction.
Now, it's really important we don't turn Graham's approach into some kind of rigid dogma, right? Like suggesting only companies trading below tangible book value are ever worth owning.
Absolutely not. And Graham himself provided the counterpoint. He found, in his own testing, that a basket of what he called goodwill giants, you know, those huge, high-quality companies with massive brand value and strong cash flows, the ones trading far above book value actually performed quite well during his test period.
So that finding forces us to acknowledge that value isn't just about tangible assets.
It proves that there's real durable value in things like competitive advantages, brand loyalty, network effects, even if you can't easily measure them on the balance sheet in the same way you measure a factory.
Okay, but wait. If our whole enterprising strategy is built on safety, tangible assets, avoiding paying for future vision, doesn't validating the purchase of these goodwill giants kind of contradict that? Doesn't it sound like the story-based investing we were trying to avoid?
That's a great question. But I don't think it validates the story so much as it validates the proven cash flow durability. There's a difference. It's one thing to pay a high price for a fast-growing company that might become durable someday. It's another thing entirely to pay a sensible price for a company that has already proven its durability and cash-generating power over decades.
So it's about paying a fair price for proven quality, not necessarily a bargain price for potential quality.
Exactly. And owning a few of these elite, cash-rich franchises bought at sensible prices can actually create a nice balance in a portfolio. It's like a barbell strategy.
So?
Well, these high-quality, stable businesses can balance out the inherent volatility you get from a deep value basket of potentially troubled companies. They can smooth the overall ride of the portfolio. And that actually improves the odds that you, the investor, will have the temperament to stick with your entire discipline plan, including the deep value part, during rough market patches.
Okay, so what's a simple rule of thumb for identifying these quality businesses that might complement the deep value basket?
Maybe think about elegant simplicity. Can you explain in just 1 or 2 sentences how this business makes money and why its rivals can't easily take its customers? Is its dividend consistently funded by actual free cash flow, not debt? Is its balance sheet truly fortress-like with a minimal debt?
And if all those are true,
Then paying a fair, market-sensible price, not necessarily a deep bargain price, but a reasonable one, might be perfectly acceptable. For these kinds of businesses, you're often letting time and compounding do the heavy lifting for your returns, rather than relying solely on a big multiple re-rating like you are with the deep value names.
okay, so we have the screen, we have the philosophy, the behavioral guards, but we also need explicit risk controls, right? The brakes for the engine.
Absolutely essential. Layering these practical constraints on top of the screening process is vital for protecting the overall strategy.
Let's start with basic trading and market constraints. Liquidity seems paramount.
It really is. You absolutely must avoid positions that you couldn't realistically sell over, say, a few days without significantly pushing the price down against yourself. Small cap stocks might be okay if they trade reasonably well, but venturing into really illiquid microcaps can be disastrous if you suddenly need to get out because the thesis breaks.
Okay, avoid illiquidity. What about governance?
Requires real diligence. As we touched on, we strongly prefer companies where insiders, management, directors are actually buying shares with their own cash on the open market. That aligns their interests with yours far better than just receiving big option grants. You really have to dig into the compensation footnotes in the proxy statement to see if management's incentives truly reward long-term conservative value creation.
And we need to be vigilant about accounting quality, especially today.
More than ever. In this era of constant adjusted earnings and non-GAAP metrics, you have to be skeptical. Stick to the raw, hard numbers as much as possible. Focus on the cash interest actually paid, the cash taxes actually paid, and try to estimate the true maintenance capital expenditures, the amount needed just to keep the existing business running, not necessarily for growth.
So treat anything labeled adjusted with extreme caution.
Yes, and demand a higher margin of safety if a company relies heavily on adjustments to make its numbers look good.
What other risk controls?
Well, diversification, as we keep saying, is your main protection against being wrong about any single company. Maintain that minimum of 15 names, ideally aiming for 20 to 30, spread across genuinely unrelated industries to dampen sector-specific risks.
And finally, define your review cadence.
Exactly. You need a schedule. Maybe a quick quarterly check, just scanning for signs of major financial stress, a big debt increase, a cash crunch, followed by a much deeper dive once a year, probably timed at the release of the annual report or 10K, where you thoroughly reassess the original investment thesis for each holding.
This disciplined approach, it also implies sometimes the best action is no action.
That's a hugely important point. You need to build your do-nothing muscle. Often, after you've done the hard work up front and bought a company carefully according to these rules, the single best decision, especially in this enterprising basket, is just to sit tight and let the process work. Let compounding and normalization happen. Resisting the urge to constantly trade is itself a deliberate, often very profitable decision that minimizes costs and prevents emotional mistakes.
Graham was always practical. He actually advised practicing this stuff before putting real money on the line, didn't he?
He did, and we strongly recommend it too. The best way: create a paper portfolio. Track it diligently for at least a full year using real-time market data.
So step one is actually running the screen we built.
Rigorously. Use a good financial screener to find, say, 30 names that pass all the quantitative hurdles, steps A through D. But then, critically, you must apply your human judgment layer, step E, to that list. Filter out the ones that don't pass the smell test.
Okay, you've got your paper portfolio of maybe 20, 30 names. Then what?
Track the results meticulously. Compare the performance of your basket directly against a relevant benchmark, maybe a broad market index like the S&P 500, or if you focused on smaller companies, the Russell 2000. And for every single stock you selected for the paper portfolio, force yourself to write a concise, one-page thesis.
Outlining why you bought it, the risks, the expected catalyst.
Exactly. This isn't about predicting the future. It's an exercise in forcing process discipline. Did it meet the criteria? What are the key risks? Why do you think value will eventually be recognized?
What's the real payoff from this practice here?
The discovery you make about yourself is invaluable. If you find that, honestly, you don't enjoy the deep dive analysis, the tracking, the footnote reading, or if your simulated results are just consistently poor or unreliable, That's not failure. That is a discovery to celebrate.
Because it tells you this specific strategy isn't right for you.
Precisely. It means simple, low-cost index funds are probably the right tool for your long-term wealth creation. And finding that out via paper trading saves you potentially years of frustration and, frankly, expensive real-world mistakes.
But what if the process does hold up? If you enjoy it and the paper results look decent?
Then you start small. Very small. Keep the vast majority of your serious wealth in those diversified low-cost funds. That's your stability anchor. Allocate only a measured, maybe quite small portion of your capital to actually implementing this enterprising basket strategy.
Why start so small with real money?
It keeps the emotional pressure incredibly low while you're still learning with real stakes. It maximizes the learning curve because you're focused on process, not nervously watching every tick. And crucially, it protects you from making a potentially career-ending mistake by betting too big on this strategy before you've truly mastered it through different market conditions. Low pressure, high learning, essential risk control.
Okay, we've covered a lot of ground translating Graham for today. Let's try to synthesize this into maybe 3 key takeaways for listeners thinking about applying this over the next decade or so.
Good idea. First, I'd say remember that scarcity is cyclical.
Meaning those extreme balance sheet anchored bargains and net nets or near net nets. They might seem extinct in a roaring bull market, but they're never gone forever.
Exactly. Market fear spikes periodically. The rule isn't to predict the next spike, but to be prepared when it happens. Have your watch list ready, your playbook written. And remember, cheapness alone isn't enough. The catalyst often isn't just the low price. It's the combination of cheapness with a strong balance sheet airbag and proven business durability.
Okay, scarcity is cyclical. Be prepared. Takeaway number 2.
Acknowledge that intangibles complicate the math, but don't invalidate the principles. So much value in successful modern companies comes from software, data, network effects, brands. Things that don't fit neatly into Graham's original net tangible asset calculations.
That's acceptable, but requires adjustment.
Yes, it's acceptable, but you must demand an extra margin of safety when most of a company's perceived value is intangible. Maybe require deeper discounts, stronger evidence of cash flow durability, or even clearer competitive advantages. The core idea still holds. Strict price discipline combined with strict cash flow discipline still works, even if tangible book value plays a less dominant role than it did in Graham's time.
Got it. And the 3rd key takeaway.
Perhaps the most fundamental, temperament is the real edge. Always has been, always will be. The broad market, the crowd. It will forever prefer exciting narratives and confident, high-octane forecasts over humble, boring arithmetic. People want the story of the next 10-bagger. The enduring advantage for the enterprising investor comes from consistently, unemotionally choosing the arithmetic, choosing discipline, choosing conservatism, especially when the market is rewarding speculation and hype.
So Graham wasn't really teaching stock tips.
No, he wasn't teaching tricks to get rich quick. He was teaching a highly disciplined way to behave in the face of market volatility and psychological pressure. It boils down to this. Decide your rules when you are calm, rational, and objective. Then summon the iron will to follow those rules without deviation when you are not calm, when the market is fearful or greedy or just plain irrational.
That disciplined behavior is the advantage most people never develop.
That's the core of it. That's the true enterprising edge.
Well, that feels like a good place to wrap up our deep dive into Chapter 15, Building Graham's Modern, Usable Playbook for the Disciplined Value Hunter. Thanks for joining.
It was a pleasure. And remember, our mission here is to teach disciplined, long-term investing using principles that truly last. We'd love to hear from you. Tell us which concept you want us to tackle in a future deep dive. Should we dig into the nuances of ROIC versus ROE? Explore Buffett's concept of owner's earnings? Or break down the trade-offs in corporate capital structure? Let us know.
Yes, please do. And if you found this useful, like the episode and subscribe. It really helps us keep these lessons free. Feel free to leave questions for us too, and we'll try to build future Q&A sessions around them. See you next time.